Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is April 26th of 2022 and markets are down across the board. We have a risk-off trade. Again, markets are actually retesting the March lows earlier this year. And again, for all the major indices, it hasn't been a pleasant start to the new year. But you know, we're going into earnings season right now. We're going to spend all eyes. Over 50% of the S&P 500 are reporting earnings this week. So we're going to find out sort of picture preview into how those companies navigated higher input costs, higher inflation costs, higher wage inflation, and what they did ultimately to pass it on to the consumer or not. And was that margin compression internally? You know, the S&P earnings right now are still growing. They're at a 6.6% estimated. And if we get through this earnings season, let's say in the next 3 or 4 weeks, and we find out that we're a little bit higher than that 6.6%, maybe 7 or 8% in terms of a margin or earnings growth, that is actually a substantial win. Earnings are growing. Markets are now pricing in what the Federal Reserve has ultimately been doing, which has been extremely hawkish, extremely aggressive. And why are they doing that? Well, the Fed really has a problem because they're behind the yield curve. Ultimately, inflation is running rampant in just about every marketplace, from used cars to inflation at the pump to, grocery stores, as well as, housing right now. And I think that's ultimately what we're going to see from the Federal Reserve. Maybe next week, a 50 basis point increase. This week, it's earnings. Next week, it's the Federal Reserve. That's what the markets are sort of trying to position ahead and draw down ahead accordingly. And we're retesting those March lows. But I think the Fed's target right now is housing, because if you think about it, the cure for higher prices and a lot of the inflationary areas of the society, of the economy, are going to take care of themselves. Right? Higher prices will basically slow down. Higher prices, people will say, you know what, I'm just not going to spend that money for it because I don't think it's worth it, whether it's a consumer good or service. But that being said, right now, the housing market, we're seeing cracks and signs of slowdown just ever so slightly. This could be what the Federal Reserve is trying to do. Think about this. They raised housing costs by 25%. So housing affordability is down by over 30% year to date right now. And one of the things is they want to slow down housing. Now, are they actually doing it? Well, if you look at the housing supply, by month's housing supply across the United States, according to the National Association of Realtors, the February was a 5.6% month worth of supply on the market. We know that number has been shrinking every year up to February, every month over month up to February. But this last month, we just saw a report. The March report just came out at 6.4%, sort of a slight uptick in supply. We're also seeing, prices soften a little bit. If you look at the markets, like as an example, San Francisco market, average days on market for San Francisco used to be at the very beginning of the year 7 days average day on market from when the home hit the market to the way it to when it got into contract. Now it's 47 days on average. So there's slowing in some of the coastal regions. We're also seeing, we had a client today call us and we were looking at a property for them in Paradise Valley in Scottsdale, Arizona. And we did a sort of a market research report. And we found out in that area right there, we see in the price point that he was looking at, prices are coming down. We're seeing some softening in terms of at least the asking price. Now, let's be honest, when you're selling your home, you want price to perfection. So you're going to put it out there for the highest possible price. And ultimately, if you don't get the buyers or has to stay on the market longer, you're going to have to come down in some of the pricing. So we're seeing that across real estate. And that's one of the reasons why we believe that the Federal Reserve is targeting housing, because of the inflationary inputs. So right now, we'll see if it actually plays out like this long term. Do we think it's a crash or a bubble? No, but we do see a slowing in housing for certain, because the housing affordability is definitely going down and the prices for just inventory are increasing. So the risks of recession are rising. We obviously have a tight labor supply, tight market for labor, but we're also going to see in the corporate earnings right now what corporations are going to say. They're going to have the have and have-nots. You're going to have corporations that are going to report top line and bottom line exceeding expectations, allowing to pass on the inflationary costs to the end consumer, and then consumer is still going to buy whatever good or service they have. But we're also going to see the other side, some companies that are going to struggle right now, and that's going to be an early indication that we're going into a recession or a pre-recession for the market by saying, hey, we're going to lay off some of our labor And so I think we're going to have some of the companies right now that have already reported, they're saying, hey, the reduction in employment or some of their employees right now. So that'll help ease the tension on labor tightening. For the Fed is going to have to basically take that into consideration if we get any more of that. So we have early signs that the recession is potentially bubbling for the economy. And by the way, we have the Dow, the NASDAQ, and the S&P all retesting March lows right now. But are stocks fair valued, Rob, or is there more room to go lower? There's obviously always more room to go lower. We really don't know. But where we do know is we're looking at the moving averages right now, and we're looking at where the retests of the Dow, S&P, and the NASDAQ are, and they're exactly where they need to be. Now, if they break lower, we could be seeing some lower lows on the market, but we could see a retest right now, and potentially with the corporate earnings coming in stronger than expected, or at least above consensus right now, we could be going through the process of a bottoming, which could help us not say market's going to turn around right away, or that trend, that negative trend that we're seeing or feeling, and the markets turn around just immediately. But it does sort of give us a pause or a breather. Now, what do we need to look for that? Well, it's the washout sort of downtrend that we saw today on sell-off for markets, such as the VIX over 30. So we're at the 32.3 right now. Last March, we were at 35-ish. So mid-30s, anything mid-30s for the VIX. And remember, the VIX is just the volatility index, which just says, hey, listen, tap out. It's the white flag. I'm out. And you start selling everything on the individual investor side. Even institutions as well pile in from that point. But that usually is the indication of a bottom in the market. In fact, it has been a pretty great historical barometer that we're watching. And also are the price to earnings ratio, the forward PEs for corporations. Now, if corporations gap down or guide down in their earnings reports, I don't think they will, but they will say it's challenging going forward. I mean, what CEO wouldn't in this environment? That's almost like a no-brainer. But the 5-year and the 10-year price to earnings ratio right now on a forward-looking basis, just for the market in general, we got a 16.8 on the 5-year and an 18.6 on the 10-year. So we're right in line with right where we need to be. With the market is right between the two of those right now. So that's a healthy sort of correction where we're in good territory. And I just had a conversation with Don today back in Wisconsin. And believe it or not, whether it's 100 degrees here in Palm Desert, California, it was actually snowing in Wisconsin for Don today. And so he and I always talk about the market, and he basically said, hey, Rob, markets like this, it's a good time to look at what we have, longer term view, but more importantly, as prices come down, yields go up. Again, most of our portfolios are geared towards dividend growth, yields, dividend income. And so as the price of the stock comes down for momentarily, right, stocks go up and stocks come down. But in the meantime, we're clipping those dividends, we're clipping those coupons, we're getting that cash flow. And so that can't stay down too much longer for too much sustained period of time, because buyers will come back in, because that dividend yield goes from 3 to 4 to 5 or 6%, depending upon what companies we're looking at. And that cash flow becomes very attractive. It brings in money. We have a lot of money on the market or in the sidelines ready to go in the market. So again, we're going to hopefully see a retest of the bottom of the retest right now, double bottom for these March lows that we saw earlier this year. By all valuations, let's keep an eye on the VIX. Hopefully we have a washout, and then see also what earnings bring, because we have big tech earnings later this week, and then later we have the Federal Reserve. But I think Fed is going squarely after housing right now. We're seeing cracks and signs and slowing in housing. So you want to put that on your radar as we speak, and just put that on our dashboard and take notice. But right now, we're going through a cleansing in the market, and hopefully a rebound by the week's end. We'll see how this plays out. Thanks for watching.